For A-level economics, you need to know about the last 20 to 25 years of British economic history, which is effectively since the turn of the century. Conditions for events in the 21st century are often grounded in the trends from the late 20th century, so let's rattle through some of them first. The 70s was a time filled with turbulence. Under the backdrop of deindustrialisation and oil crises, there were a string of strikes called by the UK's powerful unions, culminating in a 3-day work week, as there was not enough electricity being generated to run the economy full time. Wages were pressed, and the UK economy was at an impasse. So along came Thatcher, implementing sweeping economic reforms, including privatisation and anti-union legislation, under the backdrop of a global recession. This fundamentally reshaped the UK economy, enabling the future growth of the financial sector and other service-based sectors. There were, however, significant short-run issues, including high unemployment, inflation, appreciation, and regional inequality. Tony Blair became Prime Minister in 1997, promising more spending on, what was it, Tony? In addition, there was extreme monetary policy reform, including independence of the Bank of England. The start of the 21st century was a nice time for the UK economy. That's nice, as in macroeconomic indicators were broadly positive, and nice, as in non-inflationary, continuous expansion. But why did this happen? China's acceleration towards being the manufacturing powerhouse it's become was due to a variety of factors, including lower labour costs, looser regulation, and decreased global shipping costs, that have collectively become known as China price. This saving meant SRS has shifted right in the UK, leading to lower prices and higher output, GDP going up, causing improvements in key macroeconomic indicators. Of course, China wasn't the only developing country growing at this time, and also we saw more interconnectivity between different sectors in well-established trade partners. Increased institutional independence, particularly for the Bank of England, led to an increase in confidence and capital being freely flowing, leading to more consumption and less saving, more investment, AD going up, and economic growth. This extra spending wasn't causing massive inflation, as it likely would now, because SRS was shifting right, as we previously mentioned. Often, economic downturns are caused by global effect of big problems of systems set up to try and advance human experience. This period didn't have particularly seismic changes in the global macroeconomic system. Not to say there were no problems or macroeconomic events at all. The severity of any external effect will depend on the exposure to the shock and the response of different economic agents. In this period, the UK was a mixture of lucky, well-placed, well-prepared, and competent. Unfortunately, the same can't be said for the time since. The global financial crisis was caused by the mislabeling of financial assets that were integral to the new financial and monetary systems, and an overly risk-laden approach to financial speculation. This created a bubble, particularly in subprime mortgages, which, when burst, meant banks didn't have the asset value or liquidity that they thought they had. As asset demand went down and supply went up, because banks were trying to sell some of their assets, this meant that financial asset prices went down. This affects people more broadly than just in the financial sector, as prices of other assets would likely go down due to decreasing demand. This in turn would lead to lower confidence, consumption going down, and AD going down. Effectively, you have a negative wealth effect. Additionally, as banks had less liquidity and there was less available collateral and wealth in the economy, the availability of loans went down. This caused investment and consumption to decrease, further lowering AD, and potentially a fall in LRS growth. In all, the global financial crisis led to a long period of low growth of GDP and productivity, higher unemployment, and a large negative output gap. It also helped to exacerbate. As recession struck globally, some countries found their national debt burden to be a major problem. Due to their inability to devalue their currency due to the economic union, and a lack of available capital from foreign markets due to the tighter financial markets from the global financial crisis, some Eurozone countries struggled to repay their debt. This meant they had to receive financial support from other countries, the European Central Bank, and the International Monetary Fund. These bailouts were often conditional, enforcing strict government spending cuts, higher taxes, as well as the additional cost of borrowing coming from the lack of confidence from international investors. In 2011, Greece was having to pay over 135% yields on their 20-year bonds, meaning long-term borrowing was almost unaffordable. Partially to avoid a similar situation, the UK government felt it necessary to introduce austerity, cutting government spending and raising taxes. This has been one of the main policy programmes in the UK since 2010, when the coalition government first came to. This low productivity and GDP growth cannot be entirely attributed to austerity. There are longer-term effects linking back to deindustrialisation, but austerity certainly didn't help to ease these problems. Brexit has been a major source of uncertainty in the UK economy since a referendum was called in 2015, until, and even after, its implementation in early 2020. The UK has seen an increase in import prices, largely due to the increasing cost of bureaucracy, as well as a decrease in investment due to a lack of confidence. This will cause SRS to shift left and cause downwards pressure on AD, as well as reducing the rate of LRS growth. COVID, and the lockdowns implemented, caused some of the biggest GDP falls the UK has ever seen. A cessation of economic activities and a reduction in confidence saw a huge fall in consumption and investment, lowering AD and potentially leading to labour hysteresis and capital depreciation. Overall, the UK economy in the 21st century can be split into four main parts. Firstly, the nice years, then the 2007-8 global financial crash, the slow recovery from said crash, and then COVID. That's led us to recent times and the cost of living crisis, which we'll talk about next time.